Welcome and thanks for watching this month's investment video. I'm Ross Bramwell, a member of Hamrickberg's investment team. With the Federal Reserve set to cut rates this month, the only question appears to be whether they will cut a quarter or a half of 1%. As the markets are pricing in up to 4 or 5 cuts by January, an additional quarter of 1% this month may not make a big difference for the economy right now. But investors may perceive a larger cut as a signal that the Fed believes the economy is slowing faster than projected, and that it may need to move quicker in future rate cuts. In this video, we'll discuss how market leadership has shifted since July due to interest rate expectations and what that could mean for markets going forward. For the last 18 months, big tech, or the Magnificent Seven as the largest companies are often called, have dominated the earnings story and market returns. This has led to a high concentration of the S&P 500 index in just the largest names. However, since July, that has changed. Big tech's dominance has lessened in recent months. Here in the chart on the right, we can see that the top two lines, the blue and dark green, which are the S&P 500 and then also the NASDAQ index, have led the way for most of 2024 and overall. But on the chart on the left, which shows the performance since July 1st, it shows a different picture where small caps using the Russell 2000 and also S&P 500 equal weighted to show the shrinking dominance of big tech, they have actually outperformed in the third quarter as expectations around interest rates have shifted. This rotation began when it became apparent that the Fed would begin rate cuts in September, and also that the Fed may have to quicken the pace of rate cuts. But it's also tied to the expectation of a soft landing. If we focus on small caps since July, we can see a bounce in mid-July as additional rate cuts were priced in before year end. But also there was high confidence of a soft landing given stellar earnings and economic data in July. However, that changed in early August with a weaker than expected jobs report that sent all stocks lower, but especially small caps. This was because recession fears escalated quickly once unemployment was reported at 4.3%. However, after a few weeks of reassuring jobs data, including lower initial unemployment and continuing unemployment claims, those recession fears have receded somewhat. This is because small caps tend to underperform going into recessions. History shows that as the business cycle peaks and subsequently begins contracting, small cap stocks tend to underperform large caps. Large cap companies typically have easier access to capital and stronger cash flows than smaller companies. This relationship may even be stronger today given that over 40% of the Russell 2000 has not turned a profit in the last 12 months. Small cap stocks tend to outperform leading out of a recession. Small cap stocks have outperformed large caps in 6 out of the previous 6 recessions, going back to 1980. The difficulty here is that the end of a recession is only clear in hindsight, looking backwards. But the story still stands that small cap stocks are typically more levered to fluctuations in the U.S. economic cycle and its rate of change than large cap stocks. Focusing on the point that over 40% of small caps have not been profitable in the last year, here we see this data laid out. Larger companies have been able to withstand the higher for longer rate environment better than small companies. Here we can see that large cap companies, represented by the Russell 1000 here, the top 3 rows, are closer to their historical averages for companies that are not profitable in the index. However, small caps, here with the Russell 2000 data, they are within shouting range of the highest readings of unprofitable companies in the index. Higher interest rates have been a significant increase in their expenses into the profitability. In late spring and summer, after some higher than expected inflation data, markets were only expecting maybe 1 rate cut this year. That happened right here in the middle of the chart. And many were talking about how the Fed would have to push off any rate cuts into 2025. However, after inflation trends improved and are now below 3%, the markets have made quite a turnaround and are now pricing in at least 4 rate cuts by year end. This shift in expectations has led to a change in market leadership. One of the reasons small caps may benefit from lower rates is that, as mentioned, small caps are more reliant on debt, in particular floating rate debt. Larger companies with a strong balance sheet are often able to secure long-term debt, which is often fixed rate. This chart shows the disparity in how higher rates have impacted small cap companies. This has been a direct hit to their income and profitability as interest rate expense has skyrocketed. If rates decline, they should also see the larger benefit to their profitability. The question is, how long will it take to materialize? The expected pickup in earnings for small caps now appears that it's going to take a little longer to materialize after the second quarter reporting season. But the good news is that the second quarter's earnings for the other 493 stocks was positive for the first time since the fourth quarter of 2022. So the earnings story is starting to broaden. If the Fed can continue to navigate to a soft landing, meaning no hard recession, then it's quite possible that the lessening of tech's dominance should continue. However, if economic data turns sour and the Fed has to cut faster to support the economy, then it is likely that the small cap will once again give back its leadership. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team.